Hey, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Mike LoPiano. Wonderful to see you all once again. As always, happy Friday, happy weekend. We got our last trading day of January coming up today. We're seeing some good things. We're seeing some good things in the overall market. We're seeing some good things in terms of these data points we're collecting, right? Things I'm looking out to say, hey, is our bull trend still in place? Are we really moving into a consolidatory period here at around $27? Is this real life? So yeah, and I mean the short of it is, yeah, that's what we're seeing here. So I'm stoked about that. I'm definitely excited to couple weeks. Over the next couple weeks, we're going to have institutional filings coming out. We're starting to see some of that, some of these smaller institutions, smaller firms, retirement funds posting further accumulation of GameStop shares. We probably won't know the big boys for another couple weeks, but yeah, definitely some good stuff. So we're going to break down some of that today, as well as talk about what we might expect from today's price action heading into the end of this week. Do a little historical comparison, the whole 9 yards. We'll get into that before we head into this weekend. So for those of you who may be new to the channel, every day prior to market open, I post analytical articles on GameStop within the context of our broader market settings. So I look at broader market context, I look at technicals, I look at options analysis. I try to make sense of this to make sense of how and why the price moves on a day-to-day basis, and use this in order to continue to affirm my own investment and trading theses and decisions. So, right, this of course is not financial advice, but you're certainly welcome, right? This is open access. All of this research is open access. You're welcome to head over to my X page and check that out. It is linked down in the description of this video here on YouTube. Of course, if you're watching this over on X, it's up at the top of the page. So yeah, so excellent. Thank you very much. Let's hop into this today. We put out our first thanks go out to Goat Zuback once again for sponsoring today's research. Goat is generous enough to go ahead and buy me a coffee for today. So thank you very much, my friend. And of course to Dat Scruffdo. Scruffy, thank you so much for your support as always. Blessings and peace to your family. These guys, as well as many others, help keep all of this research completely free, open access to everybody who's watching and listening to this, who's reading this over on X, right? I'm not monetized on any platform except by the generosity of people who choose to support me. So thank you very much. So today's topic, right? We are reclaiming that weekly RSI trend line there, right? So for past couple weeks, I've pointed out, right? So I've talked a few times about these moments where we see our trading paradigms kind of break down, right? So, there's let's scroll down here a little bit, go take a look at, we can do this. Let's do it over on before we come back to this in a sec. Let's check this out here. Right. So, TA, it's, it can be difficult, right? How do we make sense out of these paradigms, right? A lot of people say it's made up or it's astrology for guys or something like that, right? And, the astrology comparisons aside, happy to talk about that on the live stream. But, really, how can you really use these paradigms in order to make sense of what's going to come? And with GameStop, of course, there's this big problem usually. So, right, the problem with GameStop is we'll have technical paradigms, right? We'll have these nice uptrends kind of form, and then all of a sudden we get these sequences of being teleported down, right? And so what happens there? Okay, so first off, what is a technical paradigm, right? A technical paradigm is a representation, right? It's a graphical representation of a number of different deeper factors, right? It's a kind of surface level painting that's meant to help trace some of the emergent properties of the complex system that's going on, right, with the market for a particular security. So what you can tell is that, these end up being guidelines. They end up being sort of psychological navigational markers that the market in general puts credence into. And what you have is you have all of these decisions that kind of come together, right? All of these individual traders making these individual decisions that then very often, because of these, a lot of these different lines that tend to be statistical relationships, they're variously expressed statistical relationships, they then get used as navigational markers. They get used by individual market participants for making decisions. Okay, so, but what happens when we get these interventionary shorting practices, right? We get this kind of linearity that gets injected, this huge linearity that gets injected into this complex system that disrupts all of these relationships. Because suddenly, right, this comes out of nowhere, and it basically overrides, right? It's like a hand being shoved into like a whirlpool in a drain. Now all of a sudden, these guide rails, right, these guiding markers no longer function as the most salient points of navigation for all of these emergent decisions, all of these independent actors in these relationships. Suddenly now, right, it's not say the the bounds of the drain. It's the person's hand that's now been stuck into the whirlpool, right? So that's how that works there, right? You want to think of these episodes of shorting like somebody going ahead and sticking their hand into the whirlpool. And now all the water particles, all the water molecules now have to move around and account for the hand primarily that's been stuck into this dissipative system. Okay, now then all of a sudden the hand moves away. And then we have, all right, well, then we readjust. And then, okay, depending on how disruptive this injection of the hand was, then that can determine, okay, do we go right back to the previous structure, or what happens? And sort of the more disruptive we get these kind of interventionary kind of linearities, the more it's going to disrupt that structure around us. So the reason why I've been looking at these weekly RSI trends here, if we bump out, let's bump out to 5 years, right? And Roy and Kitty pointed this out. These types of moves, if we zoom in here, these types of moves were happening in 2020, 2021. You can't see them as clearly here. If we bump down to the daily chart, you can see it more. We had these big attempts to short the stock down, right? Yeah, like this stuff. Look at this, right? May have been, right, but by and large, in hindsight, we can see how well it respected this overall paradigm. It was a bit less disruptive, I would say. But one of the things that Rory and Kitty pointed out back here, whenever we would have these big corrections, was this RSI trend line, this weekly RSI trend line, and that basically one of his principal arguments for, hey, actually we're still in this bull trend, even though we're having these massive weekly RSI trend line, we're golden. This thing's still going up. And he even made that case, right, when we were kind of, as he stated, right, barely moving up here into overbought territory, right? That's saying, oh, okay, we're moving into overbought territory. Well, time to correct. And he's saying, nope. We're still gonna move higher. I've been looking at to say, like, okay, when we get these moments where our more local technical paradigms are destabilized by, let's say, institutions taking a bunch of shares, millions of shares, and just sticking their hands in the whirlpool and disrupting this structure and its emergent properties, do we come back and do we hold this deeper structural trend? Do we hold this trend? And a couple moments this week, a couple moments last week, a couple moments the week before, right? We kind of, and we're just kind of barely, right? Like we're barely kind of below that, but basically we're like right on this trend, right? We started to dip a little bit below back when we were at, like when we were down here, or when we were down here, like on that day, the weekly candle was showing that we were below this trend line. But what do you know? Give it a couple days, and there we go. We popped back up. So last week, Friday, of course, by the end of the week, we popped right back up on top of the trend line. We had dipped below again early this week, and now here we are. Popped right back up on top of this trend line. So that's really a good signal. In fact, what we have today, right, is now we're trading back on top of the 200-week moving average. We closed on the 200-week moving average. Now we're above the 200-week moving average. If we were to close at 2770 this week, we would do something similar. So very interesting to see kind of these two weekly technical markers showing support. But that's really what I wanted to call out today. And basically what that means is that this structure here, right? This bull trend, this like this general movement, right? Even though we have this whoa swinging back and forth, maybe not this local up from $10 is still intact at the deepest support levels. That's a great thing to see. We're kind of hanging out there, we kind of teeter, but what this says to me is that whatever institutions are trying to control this down, there are institutions similarly on the other side who are saying, no, you don't. We're going to stay right on track. So there hasn't been capitulation or a desire to move out of our current pattern on the part of those institutions that have gone ahead and gone long on the stock, or who are encouraging the continuation of this bullish uptrend. So that's what I'll point out first today, and that's sort of what I have first and foremost at the front of today's article. There's not a lot of exciting things otherwise to talk about, because we are moving into this consolidatory period. Now, that's not a lot of, right? That's not volatility. We're low volume. We're all these things that don't look really awesome, on paper. It's not terribly exciting from a conventional perspective. Conventional, of course, being, something's going on now, right? This is actually a major issue. This is a major feature of GameStop, of trading in the market in general, right? That institutions look to exploit with their option sales, with their, how they move the stock around, how they move IV around, things like this. One of the reasons that their option strategies are so profitable is that they recognize that retail traders, right, typically, retail traders do not trade what they expect will happen, but they trade whatever is happening in the moment as though it will continue indefinitely, right? So, retail traders will not see, a stock is going down. It's kind of bottoming out. It's staying flat. Like, let me buy calls 6 months out. No, right? Retail traders don't do this. Retail traders go, it's going up. Let me buy a 0 DTE that I can profit off of today in case it keeps going up because it's moving up really fast, and that makes me excited. Right? That's the type of sentiment or thought process that usually gets referred to emotion or FOMO or something like that. Most retail traders, that's how they make their trade decisions, especially in the options market. So they wait until something is happening. So in that conventional sense, that kind of native or intuitive sense of, it's not exciting because something's not happening right now. I get excited looking at this because this is the type of stuff that says, but this means that the exciting stuff, there will be more exciting stuff in the weeks and months to come. Not yet, but it's still on the table, right? This thesis about, hey, we're in a requel. Hey, like GameStop is now, it's really, maybe it's going into this slow squeeze like Tesla was in 2019 to 2021, early 2022. That's still on the table with seeing stuff like this. So definitely, I am pleased to see this type of price action and to have seen this so scrupulously respected, despite attempts to really control the price down, despite the fact that a significant amount of liquidity, that is in terms of short liquidity, has been restored to institutions that might want to control the price down. So this is great. I mean, to think that, back in October, the last time we had this bottom of the cycle, right? Because we had this April cycle where we were, we only finally consolidated around $10 before moving back to the upside. The August lows were 1750 pre-market, which was mirrored in the sort of the bottom of the between the 2 May and June peaks. So August was 1750 up to 1850. And then September, I think we had a low around 1950 after earnings. And then October, we bottomed out at around 2030, 2050. So seeing this level of consolidation in what is really looking, and I'll break this down again in a second here. Seeing this type of consolidation at prices this high, with no real material change to the company besides things that were done last year, this is great. Consolidation at $27, beautiful, bellissimo, right? So, okay, so what are we looking at heading into trading today, heading into trading this week? Despite fears, despite the DeepSeek, deepfake thing, I have no doubt that this is a real story. Like, yeah, Chinese AI stuff, got to worry about it, right? But like, wasn't back in, this reminds me, in 2020 during the Tesla thing, right? There was all this hype over Chinese automakers. So NIO, Li, Xpeng, right? XPEV, whatever. These were like that was the EV, excitement, and then there were all the charging stocks, right? And who is it? And then Biden was going to do the Build Back Better EV infrastructure stuff that I guess I think some of it was built, but like this was all made out in like market news, like, oh my gosh, like all these companies, right? Some of these companies are now down like 90%, 95% from their 2020 or 2021 highs, right? And then legacy automakers were all like, oh, we're going to make all our cars EVs, and then they started to run, like I think Ford ran in there somewhere because they were going to make an EV. Fine, great, but like all of this got packed in as hype into these stocks, and it was supposed to be the Tesla killers or something like that, or challenge Tesla's share of the Chinese market, and maybe it did, but it's still, Tesla's still on top, man. So that didn't slow that down. So I'm not necessarily saying that the DeepSeek stuff is targeted toward GameStop, but in terms of our overall market context, I think this is something that is this is less threatening than I think it was attempted to have been suggested over on like this dip that we got on Monday. I still see no reason to suspect, based on the pattern of our price action, that had everything to do with DeepSeek, or I should say, I am still not inclined to suspect that had everything to do with DeepSeek and nothing to do with the repositioning of the yen carry trade. That's still my personal orientation there, just based on this, again, right, the similarity of our price action. So we got that, we got that kind of that fake early in the week. But as I said, right, what has not changed is general market optimism out through February, and as we'll see in a second with SPX, like this is now getting carried through. First off, last week into Friday, it was only carried up to about the 7th, so about next week, end of next week's options expiry. Basically by the middle of this week, it extended out to February OPEX, and by today, heading into the end of this week, now we're seeing that optimism extend out through the end of February. So it's up to February 28th now. That's what we have, right? Until we see some kind of negative market catalyst really come in to disrupt expectations. It seems like, yeah, February is going to be an optimistic month, maybe more tests of all-time highs. But that's, yesterday we saw, okay, there, Trump finally did this announcement about the tariffs. We'll see how long those last, or even if they get put into position. This, I think, was used to dump the stock, but it just recovered. And then in the after hours, overnight pre-market, now we're pushing all-time highs again, right? We're heading back up towards the call wall in SPY. And, verdicts, the jury is still out on the verdict as to even whether those are going to be put into place. He says he's going to do it, but I think people also realize the degree to which Trump also says, like, hey, here are all these things that you didn't consider that maybe I would do in order to get you to comply with this other thing that I want you to do. I'll take away this, like, don't think that I won't take away this other stuff if you don't comply with me on this. You make the decision about what's more valuable to you. Something like that, right? Not necessarily, like, I'm not making a political argument or statement about this, but I'm saying, like, this is baked into the structure of the market. Like, this is, I'm not one to instantly suspect, like, oh, okay, this is, now we're just going to totally destabilize because, Trump said something about tariffs. Like, I'm just generally skeptical about whatever MSM headline is being put in place to ascribe causality to certain price movements, or that certain headlines actually do point to some deeper trend of causality that's going to emerge, right? Anything that's coming in MSM is either something that happened a while ago that's being used conveniently in order to explain something that's happening now. It's sort of a post factum rationalization. It's not forward predicting. And of course, there's always this, dramatization and acting as though, yes, of course, we knew all along. Trust, trust CNBC or something like that. Trust Bloomberg or whatever other stuff is. In any case, yeah. So here's basically like what this structure says to me, and I interpret this basically. I learned to interpret market maker gamma exposure from Spot Gamma, who I think is really the best institution. Like, hey, I'm sure there are more knowledgeable people out there, experts who could probably poke holes in what they're doing, but they seem to me to be the most knowledgeable and have in terms of my experience, the best theories, the best practical theories, the most usable or apprehensible frameworks for understanding how to use market maker gamma exposure as a forward predicting metric. Especially, right, they focus on it in the broader market. It's a little bit more tricky with equities, but the assumptions that they use are a bit more, what would you say, enduring or lasting or something like that. They are better rules of thumb when dealing with the broader market itself. And basically what we have here is, like, as long as we're in this area, like we're either in this box or moving up through it, then what happens is we're in this call gamma positive territory. We get stable trading, and then we get a slow grind up toward the call wall as a target, with then tests of the call wall. If we breach the call wall, usually it comes right back down for a little bit, but over 5 days, we then move higher, and the option is put to traders to then start inserting new positions above and filling in call strikes and say, okay, are we ready to push for the next level? Are we ready to push for the next call wall? Are we ready to push for the next call wall? And we have last week, we had this push of we pushed up through this particular call wall and then made a move toward all-time highs at around the 615 level. Now, we didn't reach there. We did set an all-time high, but then we moved back, and now we're okay. We're making for this 610 call wall again. If we move through it, then okay, calls will start to reinsert themselves up here, and we'll push for another all-time high until something comes up that challenges this. Until the market gets surprised with, I don't know if it's inflation or jobs or the Fed or something really surprising, not something that, like, that's the thing about the tariff stuff. Like, Trump's been saying that for months. He's been saying that for months. That's not new, right? That's not new information for the market. That's been priced in for months. And the release of a news report is an excuse to play with the options market, to do something, to pull some kind of mechanical synthetic dip in order to make money, right? Off of daily price movement. That's what that strikes me as. So yeah, that's what we're seeing basically in today, heading into the end of this week. But then if we go and we look at SPX, and we look at how gamma exposure is concentrated for the next few weeks out, now we're pushing into the end of February. We're starting to look at that type of optimism. So big call optimism heading into February OPEX. Basically, right, we're seeing it, especially in the short term. Today, Monday, Tuesday, Wednesday. There's just all of next week is optimism, is definitely trader optimism. Now, does it have to stay that way? Doesn't have to stay that way, right? This isn't trade advice, and this isn't me going, I am certain it's definitely going to be fine. I don't know that, but that I can tell you from this that right now traders think we're just going to grind up. We're just going to grind up for basically like a month. Okay, what does that mean for GameStop? Well, for GameStop, that at least lends itself to consolidation. That at least lends itself to making it more difficult for institutions to force the price down, because there aren't background, there isn't context, there aren't the types of conditions to make that type of move easier. So if you're going to go ahead and try to short GameStop through these big support levels, then you're going to have to need a real reason to do that. You can't just pull that off casually to make a quick buck. As we saw, even coming out right over the past couple of weeks, attempts to even short this thing like through 2650 didn't work. And that was before we even had that level established in back-to-back weeks. Well, especially into this week is a really strong options level supported by dealer gamma hedging with respect to trader short puts. So that happened even before then. So, I mean, that in general, all of that context to me at least lends itself to continued consolidation. And we continue to see that in our options data. Yesterday moved back up a little bit to the upside, right, as projected kind of earlier in the week. Again, when we have low volume now, this is our third consecutive volume day in a row where we kind of barely cracked 3 million. We were at 3.3 million. So Wednesday, what was it? Tuesday, we were at 3.1 million. Wednesday, we were at 3.2 million. Thursday, 3.3 million. So the only times, and I wanted to point this out, right? The only times we've seen, is this what I want? Yeah, the only times we've seen that volume level, right, is that kind of back-to-back volume is when we see the depths of the volatility cycle. So we are definitely putting together consolidation at what seems to be the bottom of one of these cauldrons. So you can see we have this kind of oscillation atop the bottom, right? So this is as traders or institutions, right? They kind of rock things back and forth in order to get a little bit of IV juice so they can, make money off of more short-dated options on a regular basis here. But we see this same type of pattern. We see this kind of price action, this oscillation, a couple days up, couple days down, couple days up, couple days down. And we see these very low volume days. In fact, these 3 days that we just had in terms of trading volume were the lowest trading volume we had since late October. In fact, I believe it was these 3 days, 1, 2, 3 right here, because this one we got a little bit of a gamma ramp. And in fact, right, this is another thing I want to point out here, although it's not quite the same in terms of our price action. But last time we got volume days that were this low. We can even bring this up over on our chart here. Let's go back. Here's our weekly chart. Yeah, so we got that white candle day. I remember that. This would have been the 22nd, 23rd, 24th. So that was a Tuesday, Wednesday, Thursday, right? Even Monday was higher, right? And then these were especially low. I mean, we haven't quite hit that kind of things being that low. But yeah, so Tuesday, right? Monday was a little bit up back in this month. It was closer to 4 million. This is back in October. This is the 21st. Then sunk to 3.2 million on the 22nd. That's Tuesday. Wednesday, we were 2.9 million. And then this was crazy, right? This was I could not believe that we even got this. And this is where I pointed out, like, oh, we have to reverse after this, because this is what happened earlier, right? You get a white daily candle after basically, right, coming down like this, trying to push through this level, white daily candle. We had to go back to the upside. That wasn't going anywhere. Our record low volume, lowest we had seen since April. IV is absolutely at 52-week lows. And I remember talking about this. Said, okay, we have potential for a little gamma ramp thing ahead of. Right, we were all excited about the Cat catalyst. We were all excited about this stuff for a good reason. It did play out, and the VW squeezeversary. But then, what was exciting too for me within this structure was, okay, seeing these low volume days, seeing the price come down like this, seeing this white candle, flatness, low volume, low IV, and then we got this little run here, right? This was about $1.50 gamma ramp run, like gamma vol squeeze on a Friday, like we've seen multiple times. And this one, because it wasn't as big, I think not a ton of people remember this one. This one was low profile and it got walked back down. This was something like what we saw 2 weeks ago Friday, up to like 28.79 or something similar, right? Kind of $1.50. And then it got walked back down, right? So a lot of people not necessarily looking at that super favorably. Obviously, if you're an options trader, you get excited about that because it played itself out in like 20 minutes, right around the typically anticipated times. Kicked off like maybe around like 11 o'clock. I remember this one. So that was pretty cool. Now, thinking about where we are now, right? These are the types of conditions. Again, the setup, the price setup here is not necessarily ideal. But we do have, and this is what I pointed out in the article here, we do have a setup for this in terms of our gamma DAO. Lots of contracts coming off the board, a lot of profit taking, especially on the call side. 27's a little weaker now, not as supportive as it was earlier. 2650 puts though are staying strong. Those haven't budged. Those are those are going to print. All those traders that sold these, almost 7,000 puts, certainly 5,000 earlier this week. I mean, that's all premium in their pockets. So congratulations to whoever made those trades. Yeah, we have some OI rolling in next week. The 29 OI, I think, is relatively long. The 28 is mixed. The 30 is mostly sold calls. So about twice as many calls were sold at that strike as bought yesterday. Max Payne still at 27. That generally makes sense to me. We have Max Payne's basically, I mean, I expect February is going to pop up once we get closer, but we're just going to have 27, 27, 27, 27, 27, 27, right into March is basically what that's projecting. But okay, gamma exposure. Back to this topic of this kind of gamma ramp thing. Right, we know 2650 is supported below us because we know those are short puts. 27's kind of mixed. It's probably neutral to slightly negative. It's only really negatized. I'd say it's probably leaning closer to being neutral. Probably mostly long calls. Long puts maybe from earlier in the week, something like that. I'm not sure exactly. It's been kind of difficult to trace because that's been at the money. But it certainly isn't. We had a lot of long calls come off the board. There were a lot of trades at the bid yesterday that took the total OI at 27 down, call OI. Down 2750 is biased towards long calls. Obviously 28 is, 2850, 29. We do have the ingredients, right? And you can see this too to illustrate this concept. Like, see how high the gamma values get, right? So earlier in the week, these are probably like a third of what you're seeing now. Where like, you have the at the money strikes end up with just super high gamma values. So like all that you would need for the market maker here to hedge this entire to hedge all of the delta for this strike would be to have a dollar move. So you don't have to, like, this is 27, these are the 2750s. If you come in and this entire position will get hedged by a dollar move in the underlying. Almost this will take the total delta up to a dollar move at 28 would take, on a movement to 29 would cause, gamma hedging would be okay across that, 0.39 times however many contracts there are, 0.42 times however many contracts there are. is how many shares are going to get bought. Is how the delta will change, because you're going to take this number, add that to the delta. That's how many shares that the market maker is going to have to delta hedge in order to make sure that they can deliver on a potential obligation. With so little time left, that's what really cranks these numbers up. So you end up with all of this OI, like we saw, right? You end up with all of this OI here, all of this gamma exposure, super densely. Look at that. Look at that. See, this is the other thing too. You want to have a concentration of this stuff immediately overhead. But if you have an odd strike, like an odd kind of at the money strike like this, with this much gamma exposure kind of right there, that has typically been another sort of signal that an institution will come in and just try to blow this up, because they don't have to move it very much to cause a lot of buying very quickly, which then will juice IV, and then they can go and they can sell, right? Then that institution can both exit their contracts on the way up, because they'll become very profitable because the price will move very quickly. And then on the other hand, because they'll get that intra-week IV juice, they can then go ahead and sell more contracts. They can oversell their position by shorting calls. And then, they can let the market maker or whoever then take the available short liquidity and then just kind of walk it back down here, so that we close at, 27.99 or something, so that all these 28s are out of the money again. Something like that. So if we do see some kind of a gamma run, I would expect it to look like that, right? The most I would expect us to see is coming into the 29.50 area, right? It's comparatively weaker. We run out there. We hit this kind of much lighter hedging zone. At the same time, we have this price level, right? 29.59 is our 204-hour moving average. That has served over the past 2 weeks as a resistance level. That's going to line up nicely there. And then I think, right, you have institutions who are primarily adopting dealer strategies, then go ahead and borrow some shares and walk us back down throughout the day. They get that out of the money charm tailwind, delta decay over time, pushes things down, and then we kind of walk our way back. Probably not as low as 27, but back to 28 if we got that scenario. Of course, I can't know if we're going to get that scenario. That's going to depend on if there is an institution genuinely out there that wants to pull the trigger on something like that. That was true in the past. They did that a lot in the fall. I don't know if they're going to do the same thing. If they're going to do the same thing here, we already saw them do that once 2 weeks ago. The Roaring Kitty tweet, the Roaring Kitty post last week, I think prevented something like that, because it drew it in earlier. And a lot of that price action happened already in the overnight market. So we didn't quite see something like that happen on a Friday. With no catalyst, with no kind of external information catalyst, if we kind of open and drift down kind of into here, we start to drift down, that can, I don't know, we could move something like that. Well, and now let's see if we don't, what other scenarios could we see? Could we just see heavy shorting that pushes us, kind of surprise, and then moves us all the way back down here? Could happen, I guess. Right? That there is the liquidity to do that now. Shares are back up to 1.9 million. And then, kind of have a big reversal on Monday. Could be. Something else they could do is if the market maker just doesn't want to deal with this, the market maker kind of out of the gates maybe could do something to encourage the price, or, whoever is adopting a dealer strategy could purposefully, rather than let the price sink, they could just move it up into the 29 to 28 bracket kind of right away. So much so that it wouldn't make like they'd cut the sort of the gamma ramp in half. So you wouldn't get as much IV juicing out of running that ramp. Like if you were to let things cool off a bit into the 27.50, 27 area, and then send it up, you really jack up IV. But if you come out of the gates and you push it up to 28.50 and you just let it sit there, then yeah, and just mostly let charm do stuff for you kind of later in the day. So we'll see. I have to, I want to point this stuff out because this is a dynamic that we've seen institutions exploit many times, and exploit it recently. So, I want to make sure I point this out, because a part of this strategy, a part of why they do this, and a part of why it works is because they're able to attract a lot of people who dogpile on this, right? This is why I sort of kick stuff off talking about how very often try to trade what is happening, right? They go, oh, it's moving up now, let me buy in now, right? And chase it on the way up. And this type of quickness, because everybody's sensitive about, oh, is today MOAS, oh, is today MOAS, it exploits that type of sentiment. It exploits, oh, I don't want to miss the rocket, something like that. And then it ends up being one of these kind of fake out things where, we can see the structural dynamic in place where something like this could happen and where it will stop if it does. And, like I said, this isn't necessarily trading advice. I'm not telling you, right? I'm not telling you to go out and buy long calls and go, go play this dynamic. I mean, make your own independent decision if you want to try. Like that's on you. But I will say that being able to see this can be a potent defense, can be something that informs your own decision making, informs my decision making. Certainly, I use this to figure out, because I don't go and trade these gamma ramps all the time. Sometimes I do. Sometimes I try to, with a very, very small amount of money, because there's that variable of, I don't know if this is going to go off, right? I try to come up with strategies to capture this in a meaningful way, but an institution could, it's arbitrary. It's kind of a coin flip arbitrarily, it seems to me. Sometimes about whether an institution is going to try to do this or not. There's a lot of variables, so I don't necessarily always trade this. But what is regularly helpful to me, and why I invest time trying to understand these dynamics and spot these structures and potentials when I see them, is this tells me, okay, if I see this type of move, number one, I shouldn't be surprised. Number two, I know where it's going to end. I have high confidence where it's going to end if it does go off. Potentially how to play it on the other side, as that does happen, right? Not to go into a panic state or not to chase or something like that. And of course, right at the same time, importantly, that this is not the rocket ship to the moon type of a thing. And that's every single time that I'd say probably I've seen this structure come up pretty clearly about over the past, let's say 8 months. I've seen this pop up 8 or 9 times. And I would say 6 or 7 times. Not always on a Friday. I'd say maybe about 6 times on a Friday, maybe 7 times overall. I've seen an institution go ahead and actually do this with the stock. Now that doesn't, again, right? Historic performance doesn't predict future results. That doesn't mean somebody's going to come in and do that today, right? But if we do see something like this, that's why, right? That's what it is. So it'll be interesting. I hope later today, right? We're going to have our weekly live stream later today. I hope we have something cool to write about, to talk about and see how this goes up. I mean, we'll have plenty to talk about anyway. Lots of stuff's happened this week. Lots of we'll have the whole week's price action to review. Right, if we don't get anything, probably look at this. I continued IV slump, but I hope you guys. I hope you can benefit, from time spent pointing this type of stuff out. I hope. I hope you can use this information to make the best decisions you can, and avoid these traps, avoid these exploits, things like that. That's what I hope. That's what I hope most for anybody who's watching these, right? Yeah. So look forward to seeing you guys later today at 4 p.m. Eastern time. So we'll have our weekly live stream. we'll dig into our price action this week. Maybe think about a little bit about Ryan Cohen's 13D filing. Maybe think a little bit more about maybe what's coming up for us over the next couple months. Some dates for us to keep our sights on in order to think about how things might be transforming and whatnot. So yeah, look forward to seeing you guys then. Thanks as always for watching and listening. We'll see you. We'll see you later today. So take care. Thanks.